Good evening, friends. Let me take this opportunity to welcome you all for this webinar today, which will be addressed by Bharat Bhai on outlook on equity markets and an update on ASK portfolios. Okay, I don't think Bharat Bhai needs any introduction. He's a legend in equity markets today. And of course, it's a privilege to hear him talk about equity markets and also address on ASK portfolios. Bharat bhai, what we would request you to cover in this session is to have your outlook on markets. I think that can be followed by our philosophy that we have at ASK Investment Managers, followed by maybe an update on ASK portfolios. There have been some questions which has been asked on ASK portfolios, and then we will open the floor for questions to be asked by the attendees. Okay, that is how we would like to have this session.
Yeah, thank you, Nagesh. Good evening to all of you. So, as Nagesh mentioned, I will probably take about 15-20 minutes on economy and the markets where we are standing in the midst of some of the most important reforms which have been going on, and some more are in the offing. Secondly, I'll also talk briefly for about 15-20 minutes about investment approach, philosophy, strategy, and our mindset on that. Then I'll speak briefly about our performance of the portfolios, which in the current year, calendar year 2022, is impacted, and I want to deal with that matter and explain as to where we stand on that and what we have done about it so far. And finally, about an hour or more, I'll leave it for questions, answers, which I'll be too glad to respond to the best of my capability. So fundamentally, I believe as an economy, if I have to address the very first part, the economy of the country has never been stronger and better in a strategic sense than what it is today. And I think deep impact of that would be visible into the performance of good businesses. It will also reflect in the value creation effort and the wealth building of entrepreneurs and the business management. Finally, patient, wise, long-term and quality investors. So coming to the first point, I believe we are at a cusp of one of the most defining moments in this country's history. And the changes which have been brought about are not small, they are large. The reforms have not a shallow impact, but a deep one. And it is not for a short period. I think the effect will persist for a long period of time. Each individual reform in isolation only does so much. But when you combine many reforms together, then it creates a kind of an ecosystem where the reforms become force multiplier. Therefore, each individual reform may do what it may look like in arithmetic sum total of those reforms. But many reforms put together, the resultant impact is geometric and force multiplier. And this is something what is happening in this country. If we see the current government's first term, relatively reforms were fewer, and the policy stance on that was somewhat more tentative. In the second term, reforms have proliferated and there have been many. And I think about the policies, each of them, there is sure-footedness and great degree of solidity and confidence. And I believe assuming that the third term will belong to this government, I believe not only these reforms will multiply into many, some more are in offing. These reforms will combine together and hopefully we'll see a hockey stick kind of an effect. And because initial period of the reforms is more spent in relative pain, and the gains are something that will accrue over a period of time. And I would say today we've reached the stage where those gains are kind of beginning to get visible. This is where I thought I'll draw a bit of an attention to the nature of the changes which is brewing. I would let me just say one last thing on this topic before I briefly narrate some of the changes. The the net import of these changes is not that growth rate only will accelerate. The growth rate indeed will improve. I would believe, based on the kind of changes which have been carried out, the capacity and the capability of the economy today is for more like 8.5, 9% GDP growth rate. But I don't think we will grow at that rate because that kind of a growth rate will require exports and other engines to work well. The rest of the world is not in a very good shape, and therefore we can't easily carry on with that growth till the world normalizes. And therefore, if we try to grow at a very high rate, the economy is fundamentally is in a position to do that. But if we do that, it will create some other ruptures and issues. Therefore, while capacity of the economy today is probably at 8.5, 9% on a sustained basis, probably will grow at the rate of 6.5, 7, 7.5 for some time. By the time the world kind of heals, and therefore we have an ability and an opportunity to accelerate our growth rate. Therefore, the important point, not only rate of growth will improve, but certainty of that growth rate, durability over a longer period of time, and the quality of growth rate all are in a much, much better shape than ever before. And therefore, fundamentally, we as an economy are at a stage where the picture ahead can be that of the compounding long-term growth of a superior variety. And when I'm saying long-term growth, I do not mean merely 3 or 5 years or even 10 years. I would dare say probably a couple of decades of sustained superior growth rate is something that we have put ourselves into this situation. Let me briefly, for 5 minutes, narrate some of the important reforms. There are many. I cannot conceivably cover all of them in these relatively brief discussion. But let me just touch base upon some of the important ones which have happened. The one major change which has occurred is the important and sustained drop in the cost of capital that has been brought about. And this stands in irony of the fact that the Western world, which is America and Europe, is kind of running helter-skelter to raise the interest rates. Therefore, this is something never happened before, where the developed world is seeking to raise the interest rate, while India has brought about actually fall in the cost of capital. This has important implications on business profits, new capital formation, lending volumes, asset quality of the lenders, as well as value of the assets. Second, if you look at balance sheets of the lenders have never been better than what they are today. After significant write-offs of the loans over last 4 years, starting from 2018, and importantly, many of the lenders have raised capital in the meanwhile. Therefore, their net worths also have risen. Balance sheets of the lenders is a primary condition for growth rate to occur, and therefore, lenders are in a good shape today. Third, equally, the borrowers are in a much, much better shape. If you look at corporate debt equity ratio, has become materially lower than what it was before. And this is including the pandemic period when one would have thought that the debt equity ratio will actually worsen. But debt equity ratio has improved, debt has come down, net worth has gone up, and therefore even borrowers are in a far better shape and condition than ever before. Therefore, credit culture has improved, lenders are in a better shape, and borrowers are also in a better shape to borrow because they are in a shape of health. The fourth part, I would say, therefore, the conditions are ripe for new capital expenditure and capital formation. So far, that burden largely fell on the government, but increasingly now, the march forward for GDP growth rate, increasingly that will happen due to the capital formation at the end of the private sector. Fifth, related one, if you see, this government has made it now very clear that they do not want to be a player in the economy. They want to be rule maker. They want to be catalyst. They want to be referees, but they don't want to be a player also. And therefore, the very clear ease of doing business stance and many measures that have occurred, apart from clarity that the government doesn't want to come into the businesses and play it also apart from being an umpire, is a very important precondition for letting loose entrepreneurship. Sixth, I would say, is the adoption of technology. Uh, 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 and I would say government is even a bigger adopter of technology than the private side. United Payment Interface, UPI-based payment system, COVID-based vaccine administration platform, and now newly getting unveiled open network for digital commerce. Government has shown itself to be a very adroit and intelligent adapter of the technology. I think this adoption of technology will increasingly make India a low-cost economy, superior capital efficiency economy, and also achievement of a scale at a faster pace. The seventh part, I would say, is what are some of the deep changes in some of the areas which are occurring using digitization. Therefore, manufacturing, agriculture, health, education, finance, logistics, these are some of the large areas where big and significant changes usage of the technology is bringing about, and that makes significant parts of the economy which were not always in the same kind of a growth mode as many services have been in this country. I think they are all getting combined together in a more synergistic way. The eighth part, I would say, therefore, is the logistics that I referred to. Logistics today is about 13 to 14% of GDP. And many of the accounts would suggest that that kind of a cost can come down to roughly half the percentage, from 13, 14% to more like 6.5 to 7% over a period of 8 to 10 years. Now, in this period, economy will grow rapidly and that percentage will fall. And therefore, that will reflect in the form of significant savings for the businesses, improvement of capital efficiency, improvement in the ability of the businesses, therefore, to scale and be more competitive, not only for domestic supply, but for the international one. Manufacturing and industry will be significant gainers out of the logistics revolution that is happening. Related to that is a tremendous improvement in the infrastructure. Roads, railways, ports, airports, each of them. Last 7 years, we built 53,000 kilometers of the new highways. Nowhere else in the world it has happened. In the first 67 years of this country's independence, we built 72 airports. In last 8 years, we built 64 new airports, almost equivalent of what we did in the previous 67 years. Over these 8 years, virtually every location on the coastline of the Western India as well as Southern India has been strategically filled out to facilitate port-based logistics movement. In railways, not only speed of the new Vande trains, Vande Bharat trains, but the quality and the strength of the railways, rolling stock and repair work and efficiency and planning. All of these means that these various areas of infrastructure are now being combined in a multimodal way. Therefore, railways, port, airports, as well as roads combined in a multimodal way, digitally combined using the digital technology, and therefore the power of the logistics and unleashing of that will be one of the big changes. 10th is the change in the data, the power of the data. Today, India is easily one of the richest in data, which Mukesh Pai of Reliance described in 2008 as data is the new oil, and very prescient judgment by Mukesh Pai. Not only data is the new oil, India is one country which is one of the richest in data, and apart from that, being one of the lowest cost data service provider. And country with 850 million, 85 crore people with internet connection, with about 53 crore people who conduct activities on internet on an ongoing basis, itself means dramatic implications going forward. Related to the data is the launch of the 5G technology. 5G as a technology is not merely an improvement over 4G. It is a leap ahead in the technology. And while consumers, of course, will benefit from faster downloads and better speed and zero latency, the biggest application of 5G will occur in the enterprises, whether launching of satellites, whether space technology, whether working on robo-surgeries on a remote basis, whether evolved 3D manufacturing and machine learned AI-driven manufacturing modules. or whether synergistic health network being built through 5G. The 5G will have deep and big implication in terms of what will actually happen to the productivity, scale, and capability of the enterprises. 12th, I would say, is the startup ecosystem, which is one of the most vibrant ones in the world today. The third largest, 108 unicorns in the country today. The first unicorn in the country happened 12 years back. In January 2020, there were only 8 of them. Today, we are at 108 unicorns. But apart from these unicorns and success or failure of individual ventures, because many will succeed, but many will fail as well. But deep impact of all of them will be A, on entrepreneurship, creation of new entrepreneurship, B, new innovation models, and C, new and value creating business models. All very critical, important benefits of the adoption of adoption of the startup ecosystem. Uh, Two, three last ones. PLI, which is bringing about deep and revolutionary changes in manufacturing. PLI schemes have been identified with the national priority in mind, addressing the entire value chain. Therefore, benefits are geometric multiplication rather than arithmetic sum total. And PLI schemes are designed to address volume and at a scale, not only for local economy, but also for the international one. And therefore, PLI schemes will usher in, and already it is bringing in, for example, in the mobile phone, in mere 4 years' time, India has become now the second biggest mobile maker in the world. From a importer of 8 to 10,000 crores of mobile phones 4 years back, 10,000 crores of imports a month. Last year, we exported 28,000 crores of mobile phones net. And in the month of September alone, 2022, we exported 8,500 crores in a single month. And therefore, PLI-led manufacturing scheme is going to bring about deep changes. China being substituted by supply chains sitting in America, sitting in Europe, is become a reality. And therefore, India is one of the prime most beneficiaries, because apart from China, any country which can produce at a scale and large scale manufacturing across many sectors, it is only India, and India is a prime beneficiary there. Also, what is less regarded right now, but important change which is occurring, is a Europe plus one substitution. Europe is facing, in some sense, a crisis, not just energy related crisis, but very basic capability and value, their ability to make many things at an effective cost compared to the value delivered. They are having significant challenge. And there are supply chain management challenges with the Europe. And therefore, substitution of Europe also in favor of India is a deep and very important opportunity. Last 2 points. The transparency, which is being brought about, GST leading to formalization of businesses, RERA bringing changes in real estate, Insolvency Bankruptcy Act leading to cleanup of the bankruptcies and business failures. Aadhaar-based delivery of the benefits, socio-economic benefits directly to the people in their bank account. Some 6 lakh crore plus every year goes out through that mode. And transparency in the direct taxes, digital assessment in indirect taxes. Many of the changes mean that money will be less and less under the pillow or in the bank lockers of the people. It will be in the system. And therefore, that money which sits under the pillow has no velocity and no productivity. But the money which is under in the system has velocity as well as capital productivity. And therefore, it improves the growth rate of economy plus makes the growth virtuous cycle. Finally, I would say the confidence and the character and self-belief of the country is at the highest. Country is more confident of its destiny, is more confident of the growth ahead. Entrepreneurs are far more believers that things will happen at a faster pace. Our stature in the eyes of the world is improved, not only in the economic matters, but also in the geopolitical and social spheres. And all of these eventually lead to better economy and better growth rate, because even soft factors like influence and power and strength and respect and recognition of the country eventually translates into economic gain and economic advantages. Therefore, not to forget the way this country has handled pandemic. The whole government, people, businesses, entrepreneurs, everybody united basis has pulled the country, economy, society out of the very, very difficult period. Great credit to that. And therefore, all that builds into self-confidence, self-belief, so essential for the growth and the investment into the future. Some less known but equally important, India has now become third largest country in the world in terms of the scientific new papers filed worldwide, as well as the number of patents being registered. Therefore, from significantly behind in late double digit, India has today pulled itself as number three position in the world in new scientific papers and new patents filed for innovation. This may look like a soft factor, but a very, very important factor in recognizing dramatically changing character of the country, its capability, and its scientific prowess, which eventually translates into economic strength and the growth. Therefore, to sum it up, I think large number of changes have occurred. The changes are deep, and impact will not be short term. It will be long term. When many changes happen, the effect is geometric multiplication, and therefore we not only will have superior growth rate, but for a long duration of time, more predictable, more qualitatively sound, and therefore people have greater confidence to invest and build it. India has become number one recipient of FDI in the world, and that again says something. One more fact which might have escaped attention, but India has emerged number one in investment banking fees that the country has generated in terms of the new transactions, overtaking China. That shows large and significant transfer and exchange of assets is happening in the system to be able to build that. And therefore, all these will lead to sustained long-term GDP growth rate, which will reflect into the performance of the businesses, in turn into the character of the wealth creation by the entrepreneurs, and finally value creation by investors who are disciplined, long-term and qualitatively sound. Let me turn to the second subject, the philosophy, our approach, our mindset. Fundamentally, if I have to talk about science and art of investing, the both are important and critical, but art part of the investing is even more important than the science. Science part of the investing deals at both micro at an individual stock level as well as at a portfolio level. At a science part of the investing, at a micro stock specific level is basically series of filters or enablers that you want to see before you buy into a stock or a business. The key ones being that we want to buy a business which is character to be able to create not only superior long-term value, but also a value which is predictable and solid in its character. Very, very few businesses pass the test, single digit percentage. And we want to buy into businesses which create that character where value creation is something which is implicit in the character of the business. The second factor is the character of the management, the quality of the management. Again, qualitative factor, but very important. Ability as well as integrity, foresight and vision as well as execution, capital distribution as well as capital allocation, fire in the belly as well as resilience, adaptability, and ability to deal with the challenges. Again, single digit percentage of businesses of all kind anywhere in the world pass the test of quality of management. The third attribute or a filter that we want to see is the size of opportunity. That the business has to be business size of opportunity is to be large enough so that the business has a headroom to grow. Size of opportunity is different from size because size is a statement of fact, but the size of opportunity is a statement of conjecture or in judgment about future. Therefore, size is about past and present and a matter of fact, but size of opportunity is about future and a matter of conjecture. Without that size of opportunity, businesses cannot really hope to be larger tomorrow than what they are today. That brings to the fourth filter, that if the management has a capability and character and the size of opportunity is large, the two together has to lead to the growth. Ultimately, businesses, if they don't grow, they eventually regress. Nothing in the law of nature remains where it is. Therefore, nothing can remain static. If the businesses don't grow for a length of time, they can't remain just there and stagnate, but they will actually regress and eventually decline, if not get decimated. Therefore, growth of a business is a very essential characteristic. Size of opportunity and the capability of management together lay down the foundation for that growth. A compounding growth, long-term growth, durable growth, predictable growth, growth which is simple to understand. Finally, apart from that rate of growth and its compounding character over long-term in future, what you want is a superior quality of growth. Quality of growth is like a lubricant which allows the fact of the future growth to convert into an outcome different than the rate of growth itself. Ordinarily speaking, whatever is the future earnings growth is equal to the long-term per annum compounded future investment returns. But when the quality of growth is superior, the investment returns are higher and larger than the underlying compounding growth rate. When the quality is even, long-term growth rate is equal to long-term equal to long-term the long-term growth will equal to long-term investment returns. When the quality is inferior, the growth rate will convert into investment returns, which is much lower. And when the quality is extremely corrosive and inferior, the growth will itself mean negative returns being generated. And therefore, quality of growth is the final last important parameter before which the equation of the value comes into the picture. The size of opportunity, quality of management, character of the business, earnings growth rate in future, and the quality of growth. All these, when you combine together, it leads to science and mathematics of the value judgment of the business. Value is not a mathematical number. It is not a precise certainty. It's a judgment. It is in the future. And it's a conjecture that what may likely, in a way, occur. In a very simple term, value of a business today is nothing but a sum total of future profits of that business. That profit should be replaced by cash flow, or cash flow should be replaced by incremental net cash flow and not only gross cash flow. Because they occur in future, therefore you have to estimate the future likely economic life of the business for which business may exist. And because the cash flows occur in future, in order to bring its present value, you have to discount them. And you have to judge whether the cash flows will occur early or later, even or uneven, high or low, in a predictable or unpredictable way. All these, when you combine together and when you make a judgment, you discount them to the present and sum it all up, you get the value of the business. That value is an opinion, but a very important opinion to make, because prices invariably eventually have to be aligned to value. Price value tomorrow is equal to the price at some state tomorrow. Because at a point of time, price may or may not be equal to value. More often than not, it will not be equal to value. It will be higher or lower, or much higher or much lower. But invariably, over a period of time, even if price is different from the value, eventually it will align. Also, value is not a static number. With the rolling out of the time, a valuable business will grow at a rate of the time value of money at which you have discounted the future. Therefore, if you have discounted the future cash flows at, say, 12% or 13% or 15%, automatically value of 100 today will rise by that discount rate on a per annum basis. If the future growth or quality of growth or capital efficiency is superior than what you have assumed, value will further rise. And therefore, conjecture or a judgment of value tomorrow is equal to price tomorrow. And when you compare the price tomorrow to the price today, you know the investment returns over that time frame. Value today compared to price today is the gap is equal to the margin of safety, or a benefit to be obtained by buying that business cheaper than what it is worth today. Therefore, there are three investment returns that you make. One is the future earnings growth, that is annuity. Second is the quality of growth, which is like a cherry on the top of that cake of the growth. Therefore, the growth is like a compounding machine, the cake of the compounding. Cherry on the top, or the icing on the cake, comes from the quality of the growth. And both of these are annuity. Third one, which is the margin of safety, cheapness of the price compared to value today, is a one-time extra. If the value is 100 and the price is 80, eventually price will have to be equal to the value, and therefore one-time extra of 25% spread over the investment duration will occur. Therefore, to sum up, the science of investing is at a stock level where you want to buy a good business run by good people, people of honesty as well as capability, that it is running a business with large size of opportunity, with a meaningful growth rate, superior quality of growth. And when you combine all of this, you get an opinion of value, and you buy them at a margin of safety at a cheap price compared to value. Secondly, science part also applies to the portfolio level. What you do at an individual stock level to control risk you want to control the risk at a portfolio level too. That overall portfolio is in balance, in harmony, in a proper shape, so that a portfolio is not carried away by undue kind of a risk control, undue kind of a risk taking. And therefore, balancing the portfolio, controlling its character, as if whole portfolio were a single name, then what it should look like the parameters and the criteria that I talked about individual name, similar thing has to prevail at a portfolio level. When you complete risk management at an individual stock level, as well as at a portfolio level, the science part of investing is over. The next part is art, which has basically three components. First is discipline, second is wisdom, and third is the mental restraint and resilience. Discipline is to do the right thing, to do the quality, sorry, to buy a good business and only buy a good business at a sensible price, and not to get carried away by fashion or fade or temporariness of ups and downs of the markets. Second is wisdom, which is to ensure that discipline is not one time, but all the times to come, time after time. You have to keep doing hard work of ensuring not to get distracted, not to get carried away by temptations, and do what is right rather than what is popular. And third is mental resilience and the strength. Markets always will be volatile, but occasionally markets will be violent as well. And they can be volatile on the upward side, they can be violently upward, equally they can be on a downward side. When the markets are up and way above what you believe or unreasonably, it gives a certain smugness or complacency or an arrogance or overconfidence, and which is one of the worst things to do. Equally, when markets are down and when the chips are down or your portfolio doesn't deliver exactly as you think it should, it's easy to feel defeated and castigate oneself or do the self-loathing and lose confidence. Both overconfidence as well as diffidence, arrogance as well as self-loathing, both are big mistakes to make. Markets time to time will fluctuate in either direction, more or less, but like bystander observers, we have to remain calm, serene, peaceful, and do what is right and not succumb to the market pressure. That mental resilience is indeed probably one of the most important capabilities one needs in investing. Therefore, science of investing at a stock level and controlling risk at each stock that you buy, controlling that risk at a portfolio level, art of discipline, wisdom, and mental restraint. Basically, the investing is not about timing the market. It is not about predicting indices. It is not about riding a fashion or a train. It is not about macroeconomics. It is not global macro themes. It is not riding a trend or a fashion. It is bottom-up art and science of stock picking, controlling risk of the portfolio, ensuring that inner character of the mind in terms of discipline, wisdom, and restraint remain on a solid footing, so that the opportunity converts into outcome which is even better. Finally, I'll say the most important part of the philosophy. We fundamentally are bottom-up stock pickers. We believe in ensuring that over long run, we must deliver absolute positive, healthy compounding on a long-term basis. And even if Mr. Markets have helped or not helped, we have to have an ability to generate absolute, positive, and healthy enough compounding absolute returns over a period of time. And that we regard as our first duty of investment. The second one, equally important, is to ensure that we deliver superior result compared to benchmark over a period of time. In a long investment journey, there will be periods of pain, there will be periods of violence, there may be periods when you may do the right things, but the results are inferior. And there may be periods when markets may be generous, even if you make mistake, and markets may still reward you. But barring occasional such periods, invariably cutting through these market insults and humiliations that any investor with a folded hand is to accept, over a period of time, we regard it as our duty not only to generate a healthy absolute returns, but also superior relative returns to the benchmark. Indian economy, Indian markets, as I mentioned, afford that opportunity. And apart from that, we regard it as our sacred duty to generate both superior absolute return as well as superior relative returns over long-term investing. Finally, coming to the portfolios, uh, in 21 years at ASK, that our PMS business has been at work, there have been 3 years out of 21 years that our portfolios have underperformed the markets. 2022 calendar year happens to be the fourth year out of these 21 years when we have underperformed and fairly underperformed the market. And therefore, in a way, this is a period of chastening. This is a period of humbling ourselves. We have been, not that we feel defeated by it, at the same time, when portfolios are not doing as well as you think they have to do, we have to work harder, we have to introspect harder, we have to look within harder, and that is exactly what we have been doing. Whether there have been any process gaps, whether there has been any gaps in judgments, in assessment of the businesses, whether there has been some gaps left out in the overall portfolio construct and therefore managing risk in an optimal way, whether we have missed out something that we shouldn't have missed out, or whether we have got something that we shouldn't have got. All of these questions we have been deeply addressing and trying to work with it. Within the ambit of our philosophy, within the boundaries of our approach and method, as I described before. Wherever appropriate, wherever changes needed, we have made those changes, and we have been watching it carefully. Uh, there is no place for ego. If we make any mistake, or if we find that there are any weaknesses, it is our duty to weed it out and acknowledge it openly and clearly, rather than suffer from ego or mistakes. I would candidly also say it is not as if we made any meaningful blunders or some big mistakes or anything. We have been following our method, following our process, following our approach with the strong discipline, the way we have done it all along. It's not as if we have flirted. It is not as if we have deviated. It's not as if we have taken eyes off the ball. But there are times when there are parts in the market which may be doing well, but which may or may not be in the portfolio. The choice thereafter is whether we should be there or not, and based on that, any rectification actions. To illustrate, uh, in last 1 year, for example, public sector businesses in general have done exceptionally well. Public sector banks in particular have done again exceptionally well. Many businesses have gone up 2 times, 3 times. Some have even gone up more in a matter of a year, 15 months. We have very, very little presence in the public sector businesses. To give you an example, if you look at banks, which in last 1 year, practically all public sector banks have gone up 70%, 80%. Some have gone up by 100%, some have gone up by 200%. But if you leave aside this year and take the previous 10 years, only State Bank of India, out of all the public sector banks, have made a positive return in the previous 10 years. And that too is a small single digit positive number. Uh, Only other bank, which is Bank of Baroda, which has broken even. Over the 10-year period, it has not lost money, but it has not made any money. All the other banks in a 10-year period have lost money, varying from 10%, 20%, all the way to 70%, 80% value erosion over a 10-year period. Therefore, many of these businesses suffered from systemic flaws, weaknesses. Markets have recognized that the balance sheets have improved, like all the lender balance sheets have improved, and therefore from very poor valuation that they were at, the valuations have gone up, and because they were so low, when they've gone up, they've gone straight doubled or tripled, But fundamental weaknesses still remain. Many of these banks may have now rectified the balance sheet, largely, I would say, but still do not have capability to earn respectable return on asset and therefore respectable return on equity, two very important benchmarks for creating value in a lender banking entity. Also, most of these businesses do not have very significant talent pool. Therefore, ability to attract talent, ability to retain, which is the only important factor in a finance business, is something they have a systemic structural weakness. Therefore, our belief is, while we've looked at it closely, as of the moment, our belief still is that these banks, after doing the relatively easier part of the cleanup, the next part of making healthy ROA, healthy return on equity, and then creating sustained growth and sustained reasonable returns is something still not fully in evidence. And therefore, we are watching. Uh, some of the other businesses, many commodity businesses, given the sharp rises and changes in the commodity prices due to supply chain disruption and all that, have done very well. Most of the commodity businesses, except I would say cement, do not have either very good business economics. Most of them don't have sustainable economics. And to make matters worse, most of them don't have predictable economics. Therefore, they suffer from inferior economics of the business, unpredictable economics, and the economics which is not sustainable. And therefore, these businesses are typically either value destroyers or value stagnate, or the value stagnate, but they rarely create any value. And if they create some, it is always inferior. But this part of the market for, you can say, second half of the last year and initial period of the current calendar year did wonderfully well. Thereafter, many of them have come off, but many of these businesses have gone up sharply. Again, we have not been there because these are not long-term value creating, sustainable compounding machines. So some of these businesses have not been part of the portfolio and we have suffered. Then there are businesses that we have had and which have not done well. Names like Metropolis, otherwise a good brand, a good business, long-term, good runway of growth, quality management, and one of the top-notch diagnostic chains. On a long-term, every estimate seems to indicate that diagnostic industry itself has to grow at a healthy double digit, 11, 12, 13, 14% kind of long-term compounding. Plus that industry is still a 70 to 80% unorganized and very poor, low-level or unorganized segment. Therefore, switch from unorganized to organized will further afford opportunity to businesses like Metropolis or Dr. Lal and the like. Therefore, that also is an additional source of growth. But from last year to current year, three things have gone against them. One, last year there was a massive COVID-related testing business, very profitable, large business. This year that business has dwindled. And therefore, optically, business seems to have done badly compared to last year. Second, ironically, the normal diagnostic business, non-COVID diagnostic business, strangely has taken more time to recover than to normalcy. So now it looks like probably next month or two, probably normal testing levels will reach what were pre-COVID. Therefore, growth rates have come down even for the normal business. And it has posted, in some cases, negative growth rate. This has made the matters difficult. Plus, all the quality diagnostic chains have invested into geography, invested into people, invested into infrastructure in order to prepare for that long-term growth. With the business volumes having come down, the cost absorption has become a challenge, and therefore margins have been affected. From what were 29-30% margins have come down to 23-24%, plus the competition of players like PharmEasy trying to throw cheap diagnostic test and all that. These are not sustainable tactics, but in the short run, it causes pain. All of this has affected the top line of non-COVID business plus the margin. And finally, before it began falling, Metropolis had jumped up too sharply too much. And therefore, on a fall also, when disappointments are there, the fall is accentuated equally sharply. We have similarly suffered in a high quality, one of the best business of its kind in the world, active pharmaceutical ingredient business like Divi's Laboratory, which has done wonderfully well, which is one of the largest API businesses in the world. But last year, in the first quarter of the current year, they had massive COVID-related innovation supplies, which has not been there this year. And markets, therefore, what is a shorter-term, one-time kind of phenomena has given a punishment for that. While also the core business growth rate, because of the Europe and other worries in America, have come down from a normal growth of 20-25%. Growth rate has come down to 8-10%. To top it all, the company has invested massively into new capex for meeting the needs of the future business, which they have a kind of an eyesight on. So with the large capex, but the overall top line not being in the same order, margins have again suffered there too. And therefore the stock prices suffered. But many of these are first-class businesses run by good management, large-scale businesses yet healthily growing. And these businesses have been have not done well as per our expectations, rather they've suffered in this particular period. And therefore, some of these have impacted the results. On the other end, there are some which have done wonderfully well, and we continue to feel good about it, and we want to nurture them. Finally, I'll say we are watching very closely. We are trying to see if there are any gaps in the process, any names, overall portfolio balance, and wherever there are any gaps, small or not so small, we are rectifying, dealing with it. I want you to be assured our processes, methods, discipline continue to be what it is. In the 21st year of the portfolios that we manage, this is the 4th year that we have underperformed the indices. So we are not joyous, clearly. We are deeply chastened. But at the same time, We are not diffident. We are not depressed by that. We don't want to be in a mode where we lose confidence or do the self-loathing. Equally, when in 21 years, when 17 years we have beaten markets and beaten markets handsomely, we don't want to get overconfident. We don't want to get arrogant about it. We don't want to become too believer about what is to happen. We want to maintain judicious balance of confidence as well as caution, belief as well as doubt, uh, uh, you know, trust as well as skepticism. And therefore, we continue to watch, we continue to improvise, we continue to do whatever is required. We are broadly satisfied that there are no some large booby traps or any major errors of thinking or errors of commission. Some errors of omission may occur, but which is bound to be the part of the case. But yet we remain watchful, and we will not only we will recover the slack in of the current year at some stage in future, but we will do and get our normal compounding back. That we think is not only possible, but it is our duty, and that is what we are angling for. So I thought I'll just give a run up on the portfolio. I'll stop here and wait for the questions.
Thank you, Bharat Bhai. It was really insightful that you gave about the markets and the philosophy, and I think you touched upon the portfolios also for ASK. What we have done is, while the questions have been coming across, we have just compiled a few of the questions, and we would like to ask those questions. You rightly touched upon the underperformance of the portfolio for this calendar year for ASK portfolios. Question that has come in has been as to, in our opinion, how much time will it take for this portfolios to recover? And secondly, what steps have we taken in order to get the portfolio back on track? So these are the this is the first set of questions which has come in.
Sure, sure. I don't want to give a glib answer. I do not want to give a dishonest answer. What time it will take for the portfolio to recover the slack? Honest answer is I don't know. I wish I can say 3 months and 6 months, and it will look and say it very confidently, but it will be utterly dishonest on my part to say that. We want to be again and again introspect and see whether there are any process gaps, or there are any application gaps, there are any infirmities in the businesses that we have got. Are there any imbalances in the portfolio which is making us not post our traditional superior outperformance? But wherever these have been identified, we have taken those actions. Some weights have been reduced, some names have been changed, some balancing of the portfolio had to be brought about. What we thought was necessary in light of what we believe will be the source of value creation. All those changes have been done. And we continue to remain on watch. We are in an agile way, with our hands folded, we are watching. And we want to ensure that anything that we understand needs to be done, we will not wait for any invitation, and will not wait by any ego or any hesitation. Whatever has to be done will be done. All I can say is, whatever we can identify, whatever we think we have understood which needed to be done has already been carried out. Some more may be remaining, which we may need to work out. As we learn about it, we will do it. But I cannot artificially promise any time frame. For all you know, it may take only a month. For all you know, it may take 3 months, it may take 6 months, it may take 12 months. But I am very certain about one thing. Not only will recover this slack, but we will also thereafter recover our normal compounding at a healthy double-digit long-term compounding. That has been our history across every single strategy that we have built. Every single strategy that we have run over a period of time have delivered strong double-digit absolute returns and relative superiority over indices ranging from all the way 4 to 7.5% per annum compounded over 10 years and 15 years and 20-year period across the strategies. So, as I mentioned earlier, we stand committed to delivering healthy, pleasing, long-term, absolute, double-digit kind of compounding, as well as the portfolios have to deliver healthy, superior alpha over a period of time per annum compounded. That we remain committed to. Agility, observational mindset which is adaptive. These remain our commitments. Time frame is an outcome. As I mentioned earlier, there are times when you do perfectly silly things, and yet markets may be kind to you and allow you to get away with that mistake. And there are times when you do apparently a reasonable thing, and yet markets may make you look like a fool. The current calendar year is one such period when we feel like a later. But that's not our nature, I can assure you. And therefore, we will recover and recover more. But we will patiently do what is the right thing to do rather than in good times be overconfident or in difficult times be self-loathing or self-unduly critical. Either of the mistakes we'll prefer to avoid. So we are watchful, that I can assure you. Outcomes also will occur at some stage when I wish I knew. But barring God, nobody else will be able to cast a light. And I'm a very ordinary mere mortal. So we are committed to the task. We are at it. And with all fire at command, all patience, all discipline at our command, we are at it on an ongoing basis.
Yeah. Just to add on one more question, which is coming up, is we continue to keep holding few stocks in spite of them correcting from a particular level. For example, stocks like Sona Comstar or Dixon, which have corrected in this calendar year by a certain margin. Okay, so why do we still keep holding these stock in spite of such correction? And second, just to add to this question itself, what is our exit strategy which is applicable if a stock is not doing well? So
you see, there are three reasons for that. As I mentioned to you, there are times when prices will run ahead of the merit. Merit is basically value, and logically, time to time, price will have to match to the value. In a good business, value will rise over a period of time. It will not be static one-time value. Therefore, for a good business, price will eventually rise. Equally, for a bad business, price will eventually fall. But before prices rise in a good business, there are many times when prices fall. And this may be radiating, this may be false alarm, but it will happen routinely many times. That even for a best business, before the price eventually rises, there may be many points when prices will fall and fall rather unnervingly. Equally, the destiny of a bad business is also predetermined. That eventually price of that will fall because its value will fall. And because it will fall eventually, it will decline, diminish, and die at some stage. But even for a bad business, before they decline and die, there will be many periods when they will rise and rise materially. When bad businesses rise in between And when good businesses fall in between on the way to rise, both are traps. And these are the honey traps where big mistakes of commission can happen, where businesses may exactly be very valuable, but we may throw them away. And, we may end up buying bad businesses simply because prices are rising. But eventually, price of a good business and that of a bad business, both are predetermined. Good business will eventually rise, bad will eventually fall. But before it rises, a good business will give you a lot of scare. Many times it will give you trouble and may fall. To give you an example, a stock like Asian Paints, over 33, 34 years, I'm personally holding Asian Paints for almost 33, 34 years myself. Over the time frame, 1 rupee in Asian Paints has roughly become 1,000 rupees today. And in this period of 33, 34 years, I can't remember any time when Asian Paints has asked for any fresh capital from existing shareholders. In fact, not only the share price adjusted for everything is compounded from 1 rupee to 1,000 today, but yearly profit, they would end up giving 40, 50, 60, even more percentage of profit as dividends. And therefore, there are many, many periods when, but if you look at the journey of Asian Paints over 30 years old, it's not straight, upward sloping, smooth line like this. The line will look violent, one of this variety. There will be many periods when there'll be steady drops, and then there'll be periods when there'll be very heartwarming rises. Therefore, when you want to outperform on a long term, there are periods when you have to suffer on a short term. And equally, when you want to avoid suffering on long term by buying bad businesses, there are periods when we have to accept and stomach the insults of the market, where temporarily or for a length of time, markets may be rewarding businesses which may or may not fully be there. And to that extent, our effort is all the time to remain on three parameters: whether the value of the business is intact, secondly, whether the value will continue to grow as we think in the nature of the business and it will grow, and whether price compared to that value today or judge value continues to be favorable or not. So long as these equations are in place and so long as the business is doing right things, mind you, even on the in the current calendar year, if you look at the first 6 months of the calendar year, that is April to September, almost all our portfolios, on an average, the top line has grown at the rate of varying from 23, 24% to almost about 28, 29%. Operating profits have grown from the rate of 20% all the way to about 45, 50%. And profit before tax range may be wider, but on an average portfolio level, delivered about 28, 27, 26% kind of growth rate even in this period. So the business performance of the companies that we have invested into continue to be solid. For some reasons, markets and some of these businesses, like you mentioned, Dixon, it has suffered some challenge, not of their creation. The challenges occurred in the external environment, availability of semiconductor chips, that has affected the business of the customers, and in turn, that has affected Dixon's business, not because they've made any mistake or there was anything wrong with them. So these things happen. We have seen in the current calendar year, Ukraine war, supply chain disruption, semiconductor shortage, hydrocarbon, oil price inflation. Many things have happened which have affected. Therefore, the challenges have been more external, not internal, and therefore we have continued to remain believers. But if we think fundamentally business is affected adversely, that the adversity is material, and we think adversity is of a long period of time, then we definitely will take action. Whenever we want to rebalance the portfolio because of the misalignment of the weights, those are maintenance activity that we continue to do. And, where we think prices become outrageously high compared to value, so that economic rationale of investing doesn't remain intact, in which case we'll part with the businesses. So some businesses we have parted where we thought price performance has been very healthy, and in the material period in future, returns will be affected because of that outperformance in a big way in the present. We have sold some of those positions or removed them. So that's our selling or the removal strategy. Why we keep some of the businesses purely dependent on their fundamental merit rather than technical price position, and secondly assessment of the future, whether the value continues to prevail or not, and based on that we have strictly we are taking our actions.
Sure. So one more question which is coming in right now is there a material impact on the working style because of our partnership with Blackstone? And has the performance or the working style got impacted because of exit of Pratik from ASK? These are the two questions which I've joined together.
Well, to answer on the Blackstone part, we are gratified that we have one of the finest firms in the world in the financial sector, very agile, great value creation, and one of the most respected financial firms for its capability and the character. So, Blackstone buying a stake in our firm is a affirmation of our their faith and their trust, and we are gratified. They've been a majority shareholder, and majority shareholder definitely has a right to know, right to understand what we are doing, the philosophy and the mindset with which we are running the activity. But absolutely clearly, there has been no intrusion, no interference by Blackstone of any kind, which affects our ability to run our investments or the way we run our business. And Blackstone and we both are exactly on the same page. Value of the customer, value of customer's money, managing it well, and discharging our trusteeship responsibility is a deep article of faith for us, for me in particular, and Blackstone shares exactly the same thinking about its own customers and clients. So there is no difference of viewpoint. Philosophically, how we run our investments, Blackstone has never, not even once suggested or interfered or anything. So absolutely, I would say there has been no impact caused by that. If the performance in 2022 has suffered compared to where it should be, it is entirely due to me or my failures or my it lies internal to us. All the blame, if whatever blame that we deserve to get belongs to us. And within us, to me in particular, there is absolutely nothing that Blackstone, in fact, can be ascribed to. It will be very unfair to them to ascribe any, even a iota of anything related to current calendar. Uh, Pratik was a valued colleague. He was with us for about 11 years. Um, uh, in the 12th year, finally, he has made a change. He has certain plans, and he felt those plans personally will get accelerated, in his opinion, elsewhere. And therefore, he has chosen to leave. But Pratik has been a valued colleague, and any good colleague going is a loss. And equally, I'm not happy when I see any of my good people anytime leaving. But he was with us for 11 years. He has left it in the 12th year. Uh, Ultimately, in a world that we are in, at some stage, some changes would occur. People at some stage would have some personal and some other reasons for making some choices. What is important for us is to ensure that our culture, our philosophy, our environment, our ability to nurture our people in a right way, in sync with the accountability to our customers, which is our article of faith, those remain foremost and the most important one. And therefore, all the people in the team are committed to basically that task. And to that extent, at some stage, some people would think that they would have a different opportunity to try, or in some other format to be tried. So we respect that. We Pratik's place has been taken over by Sumit Jain. In simple terms, if I had to say, an outstanding investment professional, very solid, very high quality, very disciplined, and deeply engaged into work in investing rather than at a macro superficial level. And therefore, Sumit has been with us for 15 years. This is his 16th year with us. And I'm delighted and glad that Sumita has taken over the responsibility. We added very two senior resources last year, even when COVID was going on and challenges were there. We added two very senior individuals and one sufficiently senior individual. Three significant people were added to the team. As it is, our team in the investment activity is one of the largest in the industry, bigger than most of the mutual funds would have, or even bigger mutual funds than us. But on top of it, we have added people. In fact, we currently have planned to add 2 to 3 more senior resources to our team. So talent is very important to us, nurturing them well, giving them right culture, giving them right forum to build both their energy and strength and power of their capability in terms of results as well as accountability. All of these are very vital to us, and in a way, people with us usually remain committed to us for a very long period of time. Most people with us have been for 8 years, 10 years, 12 years more. Uh, Indeed, whenever any talent, not only Pratik, but any good colleague, valued resource leaves, I always feel a pain. I always feel a bit of me having been taken away by the person. But we continue to maintain good relationship with all the people who have moved out, and we continue to wish them uh, good journey ahead. Equally, we continue to remain committed to building strong and very high quality investment professionals who are top notch, both in discipline as well as capability and character.
Sure, Bharat bhai. Coming to the portfolio specific, Bharat bhai, there is question which is coming for IEP. Now, considering that IEP today we manage 20,000 crores of assets, being the largest PMS size, is size today a constraint for alpha generation in IEP? Is
No.
one of the question. Yeah.
A simple answer, no. If we have not generated in 2022 alpha, like I said, in 21 years, this is the fourth year when we have underperformed. Neither it is due to Blackstone, nor it is due to markets, nor due to size. Markets are what it is, what they are. There is no blame attachable to markets. Blackstone is doing what it has to do. There is no blame attachable to Blackstone. Size is what we have. We have this kind of a size even year back and 2 years back and all that. We have grown since then, but our size has been decent even then. So none of those apply. I will not like to give any excuse. If we have suffered because we have suffered in the current year. No blame to market, no blame to Blackstone, no blame to any factor, no blame to size, nothing. All of that belongs to us, and as I said, to me in particular, and that's what we remain accountable for. Also, when you look at the overall market of India, India is no longer a tiny market. It is a market of 280 trillion rupees. What are we managing? 40,000 crores out of that. Overall assets of 40,000 crores is nothing in 280 odd trillion rupees. Even at 2 times, even at 3 times, even at 5 times the size from where we are today, we will still be a dot in the ocean, even at 2 lakh crore and 3 lakh crore of assets, which we certainly will be at some stage. We still will be meaningfully small in context of the overall size of market. And therefore, this is the place of opportunity. India, I'm a frog in the whale. I don't know the full world view, but as much as I can see, really speaking, there are only two markets of depth and size and character. It is India and America. Probably there is no third of the market. Europe is in difficult shape. China is in very bad shape. Japan has been in doldrums for decades. South Korea has not delivered return for 33 years, negative returns rather. Latin America, Africa are too volatile, not created any value. It is India, whether you take last 10 years, whether you take last 20 years, whether you take last 30 years. India has been in top two markets of the world. That says something. And as I believe future is better than the past, we have every reason to believe that the future results will be at least superior to what has been achieved in the past. So with that, the market will compound, will get bigger. Our size is still a fraction of that market. Even when we grow faster than the market, we still will be meaningfully small fraction of the market. I'm actually excited about the sheer size of opportunity, and I salivated potentially what may happen over 5 years and 10 years and 15 and 20 years. So size is no constraint. If at all, we'll be constrained by our capability, not by the size of opportunity. Size of opportunity is immense. Our capability, our strengths will have to demonstrate that.
Sure. Just to take one more question, which is coming in saying, should we look this as an opportunity to add more funds into ASK portfolio with a 5-year kind of a horizon? Does this make opportune time to add more, or should we stand by, wait, look at where markets are moving, and then add money into ASK portfolios?
Well, let me answer it in 3-4 parts. One, if you ask me personally, I've been doing it every single period, I've been adding more and more to the equity as I get liquidity. I have a very large chunk of money invested into ASK strategies, running into large three-digit number invested with ASK strategies, apart from my personal portfolio. And I keep adding. I've added before Ukraine war, I've added after Ukraine war, which has been going on. I've added during ups and downs, during volatility, scare, violence, all through. As I get liquidity, I've been adding. I believe deeply about India opportunity. I believe India will not only continue to be place of opportunity, it will be one of the places of opportunity. And therefore, if the value creation is the motive, then there will be no place like equity. And if large value creation is a desired objective, then there is probably no place like Indian markets. Therefore, with a 5-year and 8-year and 10-year and 15-year mindset, in my opinion, we are at a cusp of a staggering opportunity. Markets time to time may displease you. Markets time to time may overplease you. Time to time markets will heap insults. Like in the year of 2022, we are discovering some of the insults heaped upon us by the market. At the same time, we are not cowed down by those insults. And equally, I can assure you, we will not get carried away in the periods that will follow when we'll do materially better than the markets. We, in some sense, we want to remain like a sthita prajna, like a bystander, like an observer, even though we are a player. We are a participant in the market, yet we want to keep detachment, spiritual detachment of a bystander, like an observer. Market ups and downs does cause emotional impact, but we want to listen to rationality rather than emotionality. So therefore, given the kind of long-term growth of India's economy and therefore many quality businesses and the value creation opportunity, I think many businesses will become much larger tomorrow than what they are today. They will create much bigger value tomorrow than what they are today. And all that we need is to remain committed with discipline, and where things actually become more affordable, to buy more rather than get worried or chickened out. And therefore, short answer, I would say not only buy with a long-term viewpoint, but buy as much as you can.
Sure, Bharat bhai. Bharat bhai, there are specific questions coming in respect to few stocks which have been highlighted. One being Bajaj Finance and Finserv, where there have been questions saying, isn't it done too much? Isn't it time to now part ways with Bajaj Finance and move to the next Bajaj Finance or something of that sort? And your views on Bharti Airtel at this point in time. These are questions which have been coming in.
Sure. Well, new Bajaj Finance to be found out is a tall order. Huge multi-baggers like Bajaj Finance happen once in a while. It will be very arrogant on my part to believe that we forecasted 12 years back that Bajaj Finance will become 140 times bigger in market value than what it was 12 years back when we first bought it. That will be an utter act of arrogant statement. We clearly recognize that it is a great business. It is run by very ethical and quality and capable management, and that they have a right business model, and there are good reasons to believe it will create opportunity. So we have remained with the investment. Our view as of today also continues to be the same. As recently as last week, my colleague and I traveled to Pune. We spent a lot of good time, quality time with the Bajaj businesses, and we continue to remain very enthused about the scope for value creation going ahead. Mind you, in 12 years, Bajaj Finance has compounded at an average of some incredible 59% per annum. Therefore, you can imagine over a 12-year period, it's a giant kind of a compounding. Clearly, expecting 59, 60% compounding going ahead will be a misplaced expectation on our part. But whether this business is designed to give 20, 25%, if not higher kind of compounding from where it stands today, I believe so. I believe they have a business model, they have a preparation, they have readiness, they have resources, they have character, capability, and strength of the balance sheet, and the determination to get the right results to achieve that 25% or thereabouts kind of a long-term compounding. It is a unique business. Not actually as much a business, but a unique management. It's a management where quality of management is hugely superior and ahead of the quality of the business. So Bajaj Finance is a special one, I must say. As I mentioned, our current view based on very recent, just the last week meeting, we have good reasons to believe that this is just the interim stops and this is just one of the milestones. There is still opportunity continues to be massive. Size of opportunity of lending is large. Bajaj Finance, starting with one lending vertical, that is consumer durables, unsecured retail lending. Today they deliver 32 verticals. Each vertical, they have a separate business model, team, leadership team, balance sheet, and P&L. And that's how they run. They have been adapters of technology, not today or yesterday or day before. They have invested in technology decade back as a small firm when even far bigger banks did not invest any money in technology. So they've been generally very progressive in thinking. They put huge resources into technology because they were original believers that usage of good technology will give them advantage in scale, cost, and asset quality. And they worked upon it with strength and going from strength to strength. So to summarize, we remain committed, very positive about Bajaj Finance business. We think it's a unique firm with unique capability. Not too many finance lenders can boast of that kind of a strength, and therefore we continue to remain very committed. But the fact that we like doesn't mean we don't watch. We want to continuously keep remaining on watch whether Bajaj Finance continues to be or Bajaj Finserv continues to be what it is, and whether price value equation continues to be favorable. At this juncture, we think it is favorable, and that's what we are working on. Bharti is a very strong telecom business, and it is strong because it has come out of the storm. A few years back, everything looked in a doll's drum. There was a bloodbath in telecom. The cost of the ARPUs or the realization from customers were not rising. In fact, they were falling with a severe price competition. There was a need to invest into newer technology like 4G and now 5G, and therefore balance sheets were getting stretched while profits were not adequate to commit to balance sheet. There were past dues which came upon them like AGR, adjusted gross revenue related dues that came up on the industry almost after 18 or 19 years of Supreme Court fight. One fine day suddenly out of the blue. Also, the telecom policy till then was not very favorable. And now even the new telecom policy, which happened a few months back, is one of the most progressive world-class telecom policies that we have. So they've gone through huge pain. They've gone through very, very challenging period. And not only they've come out unscathed, but they are actually thriving. And mind you, telecom is merely just the base. On telecom, using technology, many solutions will emerge, whether of commerce, whether of entertainment, whether of communication, whether of digitally making businesses more efficient and strong. Therefore, Bharti is at a vantage point of that opportunity. Plus, now the competition is settled, and therefore, average realization per user (ARPU), one round of increase has happened, and you have seen it in the results in last couple of quarters. There is a scope for much more increase over a period of time, and therefore that will be the source of growth. New new customers still get added. Then there is opportunity to convert 2G customers to 4G, and then there is a new 5G opportunity. And therefore, B2B segment where 5G will be even more relevant will throw up a new opportunity. Then there are adjacencies in a telecom business which they have been adroitly filling out. Some of them are reasonably large, some others are reasonable size, but many of them will become large over a period of time. Therefore, Bharti is in a perfect situation to be a key and major beneficiary in the without any doubt the second biggest telecom trophy market of the world. Really speaking, there are only two players. It is Jio and Bharti. Vodafone is merely trying to survive Vodafone Idea, and BSNL is forever in a catch-up game. And therefore, really speaking, large, expanding, big market like this in the world is practically in the hands of two businesses. Therefore, Bharti has immense opportunity ahead of itself. And they are very sober. They realize this. Incidentally, I met at Delhi even the very senior team of Bharti just last week. And we believe it's a business which will do wonderfully well over a period of time. Their debt levels are coming down. Current year it would have gone up because of the 5G, but debt levels are every single year it will fall. And they would generate not only good cash flow, but they will generate high and very high cash flow. And not only cash flow, but it will be free cash flow they'll be generating. So one of the best periods for Bharti in our opinion has emerged.
Thank you, sir, for that response. So, a related question is with regards to the valuations of our portfolios. So, given that you touched upon the quality of businesses, which is one of the important criterias while evaluating the stocks, do you feel that because of these rich valuations, our portfolios are not able to generate very large alphas as compared to other mutual funds or PMS competitors?
Well, I don't think our alpha vis-a-vis our competition has been much affected. It is vis-a-vis index in the current period where it is affected. But of course, vis-a-vis some competition also it is affected in the current calendar year. There is no denying that. And equally, we believe it will not be a materially long-term sustaining phenomena. At some stage, if we can't do that, then we don't deserve to be managing money. And we are very clear about it, that we exist to generate absolute return as well as a relative superior ones. That said, Our portfolio composition character, even 5 years back, 10 years back, 15 years back, 20 years back, if you go through, you will not find philosophically much difference in our portfolios. Philosophically, we have invariably looked at businesses with superior quality, uh, management with top-notch credentials, size of opportunity which is large, growth rate above the average or well above the average, and the quality of growth being top-notch and very solid. And these businesses have never been cheap. They may be on a relative basis in sync with the market at that point of time, but never per se very cheap at any point of time. If price earning multiple is a barometer to judge the cheapness, which it is not, but if we go by that, then these businesses have never been particularly cheap in that narrow definition of the valuation. So it is not as if earlier our portfolios had greater mathematical cheapness and therefore better alpha or anything. Secondly, uh, price earning multiple is a popular way to decide valuation, but I would like to submit it is not a good way to do the evaluation. It's a very poor way to judge a value. It is not merely the quantum of growth, but the quality of growth, durability of growth, predictability of growth, simple character of the business which lends itself to being able to be judged better, so that you're confident that business is simple enough that you understand why it will grow. All these attributes plus the horizon period, that is time frame, long economic life of the business, pattern of cash flow, whether early or later, whether even or uneven, whether hugely volatile or reasonably, relatively minor in volatility. All these factors and the discount rate will determine the value. Price earning multiple is actually not a barometer of value. In fact, when you judge the value, price earning multiple becomes an outcome after judging the value. Yet, unfortunately, people try to infer value from price earning multiple. Therefore, by mathematical number of price earning multiple, our portfolio may look a little more expensive, but not compared to past, because our portfolios in the past also have similarly been of a much richer and higher quality variety. And we think that our mandate is to buy high quality at a fair price, not inferior businesses at what may look like arithmetically cheap prices. So we continue to favor superior franchises, and then we want to get reasonable valuation in that superior business, not necessarily mathematically cheap, but uncertain, unpredictable, short-term kind of a market.
Sure, sir. Thanks for that. So while we've covered a few reasons of
So
underperformance.
sorry to, so from that standpoint, we remain very comfortable. Average return on capital employed of, say, for example, Indian entrepreneurial portfolio is upwards of 40%. It is well above the market average or Nifty average or Sensex average. On an average, our portfolio companies have a negative debt equity. They are cash surplus, not debt laden. Thirdly, these businesses on an average generate, growth rate, which is, I would say, roughly, 3 times GDP growth rate and roughly 2 times nominal GDP growth rate. Therefore, these businesses are strong growers and they are not merely biding the time.
Sure, sir. That would really help soothe a lot of questions which are coming with regards to valuations. Sir, although we've covered a few reasons for the underperformance of IEP, we are getting a lot of questions on India Select and the other portfolio, which we have the mid-cap biased portfolio of EOP. So there also we've seen some bouts of underperformance. So your thoughts on the way forwards on these portfolios?
Not very different compared to Indian entrepreneurial portfolio. Our philosophy, whether it is Indian entrepreneurial portfolio, India Select, growth or emerging opportunity remains the same. Philosophically, there is no flirtation. We want to buy only quality businesses, quality management, large size of opportunity, superior long-term compounding growth rate, superior quality of growth, and buying good businesses not at any price, but at some meaningful discount to the value rather than at any price. That remains our watchword. That applies to every name in every strategy at every point of time. So there is nothing different about it. But each portfolio is a mandate and it has been very specified mandate. Therefore, Indian entrepreneurial portfolio, for example, I was mentioning earlier that PSUs have done very well. But we cannot buy PSU, right? Even if we wanted to in Indian entrepreneurial portfolio, because by definition, we have to buy only entrepreneurial firms. We can't buy PSU. But at the same time, we have chosen that parameter that we want entrepreneurs because we believe entrepreneurs is a source of great long-term, sustainable, superior value creation. And therefore, we have chosen that attribute. And therefore, we are not trying to make a virtue out of it. Look, it is entrepreneurial portfolio. PSUs have done well and we can't buy PSU in Indian entrepreneurial portfolio. Therefore, we have suffered. But it's important to know that in the current calendar year, markets have been very, very skewed. Only 7 names account for the entire market performance. And therefore, it's not difficult to see that markets are in a very peculiar zone. And time to time, markets behave like this. It may not be easy to understand. It may be looking very ill-behaved at times. It may look annoying at times. But that is what markets are all about. And that's what our duty is. So, India Select, emerging opportunity, they all follow the same philosophy, same process, same approach in order to pick businesses. Only, say, in a name like Indian entrepreneurial portfolio, only entrepreneurs can come. Therefore, PSU, family-run businesses, or multinationals cannot come. Not that I'm offering that as a reason why it has underperformed, but it is just important for you to know. Only 7 names when they account for the entire market performance. You can imagine how narrowly it is focused. But that's not a permanent condition. In time to time, this happens, and eventually some names become big daddy, and then they begin to kind of fall and normalize. So in India Select, emerging opportunity, same process is being followed, same stock picking. We are also examining portfolio on an ongoing basis to see if there are any weaknesses, infirmities, either of the name or of the process to be rectified, to be dealt with. Whatever has to be done, I can assure you, once we know that we need to do something, we are not going to take time over it. It will not happen that we recognize and yet we sit over it. So whatever changes have to be done, even if there are not too many, we have carried out. And anything more comes to light, we will ruthlessly be focused on that.
Sure, sir. Thanks for your answer. So probably one last question I'll just take in the paucity of time. So, which are the sectors which y'all, as an ASK, as a house, we are bullish on? over the next, say, 3 to 5 year period. Uh, that's what might be trickling down in your portfolios as well.
Sorry.
So, which sectors? So, I'm saying which sectors are we bullish on over with a time frame of around 3 to 5 years?
No, India is a place of opportunity, and really speaking, the kind of variety and opportunity India offers is quite amazing. I would say lending is a huge area, both banks and non-banks. India is under leveraged. GDP growth rate will further expand the growth of lending, and it is already under leverage. I mentioned about balance sheets of the lenders as well as borrowers having improved. Therefore, that sets that activity on a right footing. Quality lenders will have a phenomenal period ahead, not for just 2, 3 years, but decade and two, of a strong, healthy, long-term component. Similarly, insurance, underinsured country, health, life, general, and with the growth in per capita income, with the GDP growth rate, again, that itself will be lever to grow, plus under penetration, under coverage will be another big source of the growth. Specialty chemicals, either to substitute China, at times to substitute Europe, and even otherwise, in terms of dynamism and capability of our chemical companies, is a huge area of opportunity. Active pharmaceutical ingredient, I talked about Divi's laboratory and their strength, and why that business still continues to be very valuable long-term kind of an engine. Telecom, India is easily one of the best telecom networks in the world. And our telecom firms are, in some sense, globally benchmarkable today. So our telecom firms, in terms of quality and strength of the solution, probably are among the best in the world, if not the best in the world. Infrastructure growth I talked about, that will mean cement will be a long-term strong growth area. And indeed, last 20 years, cement has grown at the rate of 6.5% in volume terms per annum compounded. Next 20 years definitely should be better number than that, given the pace at which we are expanding our infrastructure in housing and real estate. Therefore, that consumer, and not just staples, which is relatively becoming more mature, but discretionary, durables, luxury, all of these consumption represent tremendous opportunity area. Agrochem specialty, like PI industry, great opportunity. I'm not saying in the context of name PI industry, but agrochem, that we've been holding PI for long, we continue to feel very positive about its prospects in agrochem is an opportunity. Here I left out maybe digitization, those who help in digitization, those who adopt digitization. Then PLI-led manufacturing. Somebody raised the question on Dixon and price having fallen. But Dixon is a great opportunity and a chance to be one of the leaders globally over a period of time in this area. Given the large size of opportunity that exists. Therefore, many areas, many opportunities. Renewable energy is a huge area of opportunity. Select chains in the infrastructure area, also in capital goods area. All of them represent tremendous opportunities.
Sure, sir. So maybe I'll just take one last question, a very stock specific one. This is with regards to Patanjali Foods. So the questions that are coming in is that how does this stock fit in our philosophy, and specifically how does it score on the corporate governance front? So that's the question, sir.
Well, see, Patanjali has come into the picture only 3 years back. Till then, it was Ruchi Soya. And many of the concerns about governance and other factors actually are inherited concerns from that time. Because Ruchi Soya, before Patanjali took it over, had a poor balance sheet, large leverage, governance practices which were inferior, and therefore suffered from very poor perception, even though it had some excellent brands and very strong market position in their chosen area in edible oil and health related foods, where like Nutrela and others, where Ruchi Soya then and now enjoys a very, very strong position as a brand. If you take a golden nugget, for example, in southern market, it has a market share of almost 68-70%. So these are very consumer-centric products and very strong parts. The management of Ruchi Soya clearly did not do justice. And as I mentioned, the balance sheet suffered, leveraging went up, governance practices were not up to the mark, and that business went into downhill. I suspect some of those perceptions persist in the minds of people. Since the time Patanjali has taken it over, actually exactly 3 years back, Patanjali took it over. Patanjali had bought into Ruchi Soya and the change of management, and they took it over in NCLT. Occurred on 19th December 2019. So now 3 years has been completed. In this period, balance sheet has become clean. Borrowings are all repaid. There is zero borrowing. Balance sheet has a decent size of cash. On the business front, they've added 2 more verticals. Ruchi had already 2 significant verticals, edible oil and the health-related food. Uh, Patanjali has added 2 more verticals. One is that of nutraceuticals, which is one that they've added about a year and a half back. And secondly, they've added foods business, which again has been very large business, which is built as well as transferred. So in terms of the governance, if you look at, you have to give a great credit to them. Last year, Patanjali, which was 100% privately owned entity, and Ruchi was a listed entity, yet they transferred from a private 100% entity, a foods business which consisted of noodles, biscuits, and breakfast cereals. 850 crore size of the business with 162 crore of operating profit. It was gifted away virtually at a price of 125 crores, less than 1 year's operating profit. From a private individuals in the hands of a listed entity. They didn't have to. They could have done it at a market valuation, which would have been several times the multiple of that value. Then in the current year, 2022, I think around May, they shifted an even bigger portfolio of 5,200 crores, which consisted of very successful ghee, many juices, edible oil portfolio, and some of the food related offerings like honey and others. 5,200 crore portfolio, 860 crore operating profit, given away at 625 crore, less than 1 year of operating profit again. Again, it is like a gift. Now, this I would say is a great management and the governance credentials. If they wanted to, they could have shifted these businesses at a hefty price, based on the market valuation done and could have shifted. These businesses, potentially private entity has shifted to them, and they've gotten into agreement never to get into these areas by Patanjali. So that I would say is one of the biggest affirmations of the governance. The key leading lights of the business, the two sannyasis who are associated in Swami Ramdev as well as Acharya Balakrishna. I've had an opportunity to meet with them several times. I have great regard for their fire in the belly, their desire to achieve due results, and their impeccable commercial sense. Their ability to introduce new products and their innovation rate, in my opinion, in the entire consumer industry, in the food industry, is unmatched. There is no other company. They today have almost 1,000 plus different kind of products, different brands. I mean, even 100-year-old companies doesn't have that many kind of names and the brands, a fraction of that. What Patanjali has built in a matter of 15 years. So again, great innovation engine. I would say weaknesses are they need to improve their distribution. Their outlets of distribution need a facelift and better appearance. They need to strengthen their management team, and they've taken some actions recently. They've hired 2 leadership positions in 2 verticals, but they need to do more. Also, maybe they need to communicate their case better so that people appreciate it better. But I'm convinced that the 2 individuals, Swami Ramdev and Acharya Balakrishna, of which Swami Ramdev holds no equity in the firm, and he has declared clearly he'll not hold any equity in any of these businesses, but continues to be the leading light of each of the businesses. Basically, they see this as a vehicle to create enormous value, offer quality products at reasonable prices, create enormous value in competition maybe to the multinationals as well as others, so that they offer better quality at a reasonable price, and the value created, they want to give it back to the society. And in my dozens of interaction, I remain convinced that I have no reason to believe their genuineness or their commitment to the cause. In fact, it is very impressive how deeply they are committed to the cause. But obviously, till you meet with the people, till you meet with them often, till you understand really at depth, till you go through various things over a period of time, it's difficult to form a full opinion purely based on media and some other appearances, So I would say we remain grateful of an opportunity to participate there, and we remain material believers about business and the opportunity. So they are essentially riding on 3 powerful long-term trends: Ayurveda, health, and wellness. And all 3 are very powerful ideas. Ayurveda is part of the 2 food portfolios that they've shifted, as well as on the nutraceutical, which they've been building for last 1.5 years. Health is the part of already Ruchi Soya acquired businesses, quality edible oil, as well as soya-based health products, Nutrela and the like. And on the wellness, many of the products, their juices, also the nutraceuticals, many of the other products which are based on natural ingredients, not chemicals, is a very powerful position. I personally have been using some 35 odd different Patanjali products over a period of last 7-8 years. And I have some idea using the product about quality, the taste, the strength of the product, and the way they have been innovating. So we remain significant believers. We continue to watch it. We think opportunity size is large and they've seized it well, but still lots of work needs to be done to make it reach where it needs to go. From the price at which we participated, it has gone up nicely, almost twice. But still, even by conventional valuation, it remains very reasonably priced even today compared to the underlying cash flows and the profits.
Sure, sir. I think thanks a lot, sir, for your time. You spent roughly around 2.5 hours covering all the questions and covering, reiterating the philosophy which we follow every time. So that will be really helpful for the entire audience to regain faith, and also the relatively tough time with regards to the performance on the phase which we are going through. I think you've really helped us understand more in detail and regain that conviction. I think really insightful with regards to the thoughts which you shared on the stocks. So that is also very, very helpful. Thanks a lot once again, sir.
Thank you. I'll just say one last thing. Challenges spur us, and challenges is a source of opportunity, not a source of threat. It is in challenges and difficulties that we shape our thoughts better and to make our risk management even stronger. Therefore, challenges actually are thank you note worthy situations to make our opportunity, our results even better. And as I mentioned earlier, we remain committed both to absolute as well as superior relative one in terms of investment outcomes over a period of time. And not only at some stage we'll recover some of these some of the lag that we have suffered in the current calendar year, and not only we recover, but we continue on our normal compounding journey. We remain deeply committed, and therefore, in a way, philosophically, rather than getting deterred, we are hugely motivated with the interface of outside in the economic environment, the challenges that the businesses have to face, and our portfolio results having suffered underperformance. Both are a source of energy rather than source of dissipation of energy.
Sure, sir. Couldn't agree more. Thanks a lot, sir, once again for your time.
Thank you, Bharat bhai. Thank you very much.
Thanks, everyone. We
Thank you,
promise
everyone.
more sessions like these in future as well. We will have Bharat bhai also, and it will be addressed by a few of the other senior members from the investment team. So we'll have more and more of such kind of sessions. So thanks again, Bharat bhai, for your time, and thank you, audience, for your patient listening.
Sure.
Thank
you.
Thank you.
Thank you, everybody.
Thank you, everyone.